Hello and welcome to the Small Business Briefing. I'm Brian Calley, CEO of the Small Business Association of Michigan.
Good afternoon. I'm Sarah Miller, Vice President of Operations at SBAM. Thanks for tuning in today. We're going to welcome one of our new VIP members, Tata's Daycare, who was actually one of our award winners at this year's Michigan Celebrates Small Business event. So welcome to the team at Tata's Daycare. Brian, let's start out with some economic news from here in Michigan. The state's Consensus Revenue Estimating Conference was held last week, and this holds a lot of insight into how our economy is doing here in Michigan. So I have a few points we want to go over today, starting with state tax revenues. These are based on certain economic activities like sales tax, personal income tax, and business income tax. So are revenues expected to be up or down?
Well, that's the really insightful thing about the Consensus Revenue Estimating Conference is because it's a state-specific economic analysis that's performed by the University of Michigan. It does give a lot of insights very specifically about Michigan, and a lot of the stats that we look at, nationwide stats, and getting this much detail at a state level is really pretty difficult. So the purpose of it is to estimate the state's revenues. The reason that I continue to look at it in my current role, as opposed to when I was literally working for the state, is because those revenues, as you had mentioned, are based on economic activities. And there is a modest downward trend that is starting to show up in these revenue estimating conferences. So what they do is they estimate how the current year is expected to finish. And the state's fiscal year goes through September 30th. So October 1 to September 30th. And then also estimating the next fiscal year. So they had the revenues, or estimating the revenues, down 136,000 for the current year, or 136 million, sorry, 136 million for the current year compared to what they originally assumed. And then next year's they revised downward 320 million. Now keep in mind that the state's budget overall is over 80 billion with a B. So we're talking about millions, so downward adjustments of hundreds of millions, but still millions compared to 80 billion in the state's budget. So these aren't the sort of numbers that would suggest that that it's a dramatic change, but the state has gotten pretty used to year-over-year increases. And so you'll see and hear probably more this year about cuts and things, because even a slow growth, when the state's budget is slow growth or slightly reduced, it does, it's just they're not built for that anymore. It's been a long time since they've been in a position to see downward revenues. And it doesn't really concentrate so much those revenues in one area. It's just they're softening pretty consistently across the portfolio.
So Brian, excuse me, what did they have to say about employment and job growth expectations?
Yeah, and I think employment is an area where it's a particularly useful report, the Consensus Revenue Estimating report. So they are projecting that Michigan's overall, well, first of all, let's talk about the jobs in particular, and then we'll talk about the unemployment rate. So with jobs, they're expecting that in 2025, or current year, is basically going to be an even year, not up or not down. They actually showed up 300. That's an awfully precise, considering 10 million people in the state. It's a pretty precise number. But basically flat this year, and then some modest growth in 26 and 27, up 15 and 16,000 jobs overall in each of those current years. Again, very modest, compared to the size of our state. The unemployment rate, they do project to go up. So already at 5.5%, they are projecting it to go to 6% next year. And so that's uncomfortably high compared to what we had become accustomed to. And it's starting to get to the point where it's a little high even by historical standards. Michigan has generally been higher than the national average. There are some pockets of time in the last 30 years when the state was below. But they are projecting unemployment to continue to rise, that same trend that we've seen over the course of the last year.
Tariffs were included in the report. What did the revenue estimators predict in terms of the impact?
Yeah, I thought this was pretty interesting because this is something hard to estimate. And because the auto industry and the kind of connected global supply chain and integration between Michigan in particular with Canadian automotive manufacturers, these tariff questions are a bigger question mark for our economy. And so I think they put a lot of asterisks on the information because things keep on changing. But they had to do some estimates and include I don't remember really there ever being such a prominent tariff analysis in a consensus revenue estimating conference for the state of Michigan before. But it wasn't insignificant. There's a headline number 13,000. They expect there to be a negative impact of 13,000 jobs. Doesn't mean total jobs in the state go down. There's other industries they expect to go up more. But the tariffs to have a gross impact of 13,000, and basically the way they came up with it was 3,300 automotive jobs lost, and then there's a multiplier effect tied to automotive jobs for upstream and downstream connections to it. So they did actually. There haven't been a lot of forecasts I've seen out there, or at least the forecasts that I have seen have been kind of worst case scenario type guesses on what might happen. But when the University of Michigan does this revenue estimating conference, it has to be based on what they expect to happen, not the worst case scenario. And I think that it makes this, well, frankly, it just makes it very credible. They do, generally speaking, they do an excellent job of estimating revenues and consider all the moving pieces in it. So when they include something like this in it, and the overall impact, it's something that I put maybe a little more weight in this than some of the other things I've seen out there. But negative impact, not a particularly big surprise given the interconnectedness of our economy with global supply chains.
Another report released recently was the Michigan unemployment report for April. We've been trending upward for the last year. Did that trend continue?
This was actually a bit of a reprieve in that it stayed the same. So it was 5.5% last month, and then this month's report 5.5% as well. But as you'd mentioned, it has been trending upward for the last year. Actually, if I went back, it might be even a year and a half now. So that puts us at 1.3% higher than the national average, which is 4.2%. So did stay the same, but when you put that together with the consensus revenue estimating conference prediction of it rising in the future up to 6%, I think we should consider this maybe a temporary reprieve, and looks pretty likely it's going to continue to creep up.
All right, let's switch gears and look more on a national scale because Moody's has made a change to the U.S. credit rating. How big of a deal is this?
Yeah, it is a big deal that the US had a perfect credit rating, or the highest bond rating. It was the definition of risk-free investing. So if the US government owes you money, because you're a bondholder, by a treasury T-bill or something, it's the base investor rate, the risk-free rate. And so Moody's actually did a downgrade from AAA to AA1, which is one step below. So it's a big deal, but not as big a deal as when S&P downgraded it before. So there are there's more than three, but the three main credit rating agencies that are out there: S&P, Fitch, and Moody's. Moody's was the third and the final one to downgrade the US from the top rating of AAA to AA1. So S&P, it's almost like I had to look it back up because I knew that there were other credit downgrades from the other two majors In one of them, it seemed like it was quite a while ago. Get this, it was in 2011. So S&P moved the US from AAA to their rating system a little different, AA plus, on August 5th, 2011, and Fitch was August 1st, 2023. They went from AAA to AA plus. So this makes the third one. So yes, it's a big deal, but not as big a deal as when the first one did it. But it is an indication that there is growing concern over the deficit spending and the overall size of the U.S. debt. And is there really any hope of it being paid back? And I think one of the things that has really played into this is that the U.S. has a huge amount of its debt that is up for renewal. You know how like sometimes people have like a mortgage balloon and like it has to be essentially refinanced. The U.S. government has that too, and there's this big group or amount, a cohort of debt bonds that have to be renewed later on this year, and it comes to $9 trillion. And so like what the interest rates are right now is and how we're rated has a lot to say for what the US will have to pay in the future. So I think there's concern that the US is going to have to, not only is the US debt going up, the deficit spending that has been really on a binge type trajectory for many years now, that coupled with with higher rates that will have to be paid here in the near future, and a huge portion of the US debt is I think it all stacking up to something's got to give here pretty soon. So you'll see some fireworks probably out of the US, not probably, you're going to see fireworks out of the US in this kind of budget debate and what gets impacted and what doesn't. But the third and final one came through. It's a big deal. It is a big deal. Just not as big a deal as when S&P originally did the downgrade.
All right, let's talk a little bit about AI. So we ran an article a couple of weeks ago about people using AI in the recruitment process. Now we're starting to hear about the AI hiring pause. So can you tell us a little bit more about what that is?
Yeah, this is like a trend, and you're starting to see it show up in tech companies first, and I kind of expect we're going to see and hear more about it. I've actually read a lot of articles in the Data Monday report. We're going to look at a stat in particular that I think shows that the kind of the leverage dynamic between employers and employees is changing, and partly because of artificial intelligence. But in tech companies is where it's hitting first. So one of them pretty close to home, Ford Motor Company, cutting about 300 connected vehicle software jobs. And it's about 5% of the overall people that they have working in that area. And it's not because they're doing less work in that area. They're doing more work in that area, but they don't need as many people. And just the way that AI works. But then Microsoft just cut 6,000 people in the midst of a software boom. So again, their productivity, it's not that they're cutting people because sales are going down and they just don't have any choice. It's because of the technology and what it takes and what the artificial intelligence tools are able to do. So I went around just kind of piecing together a couple of things. I went kind of in search of who's talking about this right now. And Bloomberg had, I thought, a really nice and concise area where they gave examples of some of the majors around the country and what they were saying or what they're doing. Intuit, for example, in February, it's quoted saying, "We're also seeing improved coding productivity with up to 40% faster coding using Gen AI code assistance." So they're getting 40% more production out of the people doing their coding with AI assistance. Expedia in May, our marketing team is using generative creative AI both to make their marketing more effective and also to save time. Coca-Cola said this year, for the first time, our Coca-Cola Christmas ad was generated with generative AI, combining emerging technology with human creativity, which allowed us to produce the ad faster and at a lower costs. And Plantier in May said, we're not talking about co-pilots that make you 50% more productive. We're talking about agents that make you 50 times more productive. So think about that for a minute. We're not talking about making a person, 50% more productive, 50 times more productive. That just the impact of this is so big. You see it showing up in certain areas, but it's impossible really to predict what it's going to mean overall for all of us. But that if there was one thing that I was inspired, even for our work here at SBAM, to really understand, like, what does this mean for the things that we do? And instead of saying, can we ride this out, asking the question of how can we leverage this to do what we do 50 times better? And so that's that type of mindset, I think, is everybody's going to have to adopt at least somewhat, because the world is changing and it's showing. There's so many examples. When I started looking for it, it's everywhere. It already seems plurific, and it's let this maybe be a bit of a wake-up call. How's it going to impact you?
All right, let's move on to our 2026 election watch.
All right, so it amazes me every single week. There's more that happens on this 2026 election. It's almost like we're in the fall of 2026 with so many things happening. All right, we'll start on the Republican side on the gubernatorial election. So we've talked a little bit about the different folks that are running. John James got in most recently, and the big news last week was that there was a $5 million contribution that was made into a super PAC supporting his candidacy. That's just a massive amount of money to start out with. It's huge. So we know, like, Mike Cox put in $1 million, which was, definitely to be taken seriously. We know that Eric Nesbitt getting in had raised a couple $1 million, and that was pretty impressive and in pretty short order. And then here comes John James, who got in the race later, and Dan and Pam DeVos made a $5 million contribution into a super PAC that will support his candidacy. I think that really does. He was already kind of viewed as a favorite in the election, and I think that that definitely changes the math for everybody else on the Republican side. Now let's stay on the Republican side on U.S. Senate. Before I had mentioned, it kind of looked like Mike Rogers was cruising, to maybe getting the nomination without a serious challenger. And then last week I mentioned Bill Huizenga was thinking about getting in. He's a member of Congress in the West Side, and so he's thinking of getting in and running. And more on that front, that he has actually hired a consulting firm that would suggest that, and with one of the firms that it would suggest he's serious about it. So in my mind, even though he's not announced, I'm kind of considering like he's more likely than not in, which again, it's a pretty interesting development, because if he does, that means there's an open congressional seat, and that's an open congressional seat that is definitely a likely Republican seat, but not like a rock solid one. There would be interest probably on both sides in that election. And then all right, on the other side of the ticket, among the Democrats, we'll talk about maybe the Senate next time, because there's a whole roundup there. There's a lot of people getting in and talking about it, and I really hadn't investigated it enough to offer you any new insights. But today, kind of a breaking news item. with Jocelyn Benson, Secretary of State, appears to be the front runner among the Democrats to win the nomination. When you might recall, there was a little bit of news and she announced her candidacy, she was standing in a state office building. It was like in the lobby area. So I was like, well, it's open to the public. Anybody could do that. But there was a campaign finance report or violation complaint made and investigated by the Attorney General, who said, no, that's actually illegal. So kind of surprising because Dana Nessel, being of the same party, what might be more inclined to, if it was gray area, to look the other way, and found that it was a violation. Now, I don't know what type of consequences those are, but if you're the chief election officer, it's not a good look. So some rough headlines. Although, as I always say, if as a candidate, if you're going to have bad headlines, you definitely want it the year before the election. Then maybe later on they're not as big a deal or kind of socialized into the background. So still so much happening on the election front, those two statewide elections, and looking like there's going to be plenty of action at the congressional level here in Michigan too, to go along with every state legislative and state Senate, state House seat as well. Going to be a very, very active cycle.
Definitely no shortage of info here. All right, let's take a look at this week's Data Monday report.
All right, so this is one where we have to share the inflation to start with. So it's consumer price index. Actually, I got two different measures of inflation to share with you. So you'll see 2.8% being that core inflation and 2.3% including the headline inflation. So the difference between the two is to take the food and energy commodities that move up and down more rapidly out to consider the core. And you'll see both under 3%, which is pretty good. Both have resumed their downward trend. That headline inflation, you might recall, had a little bit of an uptick and then resumed its downward trend. So looking at this, compared to, or I would say in addition to softening economic data, it just really makes me believe that the Federal Reserve is not going to be able to hold off on cutting interest rates much longer. And just like inflation really it's not quite at the target levels, but it also, I don't know how anybody could look at this and say I'm more afraid of inflation than a recession. Looking at these are the year-over-year numbers here. And this shows the different categories and what's moved. And you'll notice that fuel oil, gasoline, airfare on a year-over-year basis are some of the biggest negatives here, or the biggest declines, like literal deflation. And those which is good, but but those are the sorts of things can change or reverse pretty quickly. So you really want to see the stuff higher up move, and a lot of those are smaller numbers, but the stuff that are not commodity based, when you see the inflation in those areas, that gives the Federal Reserve a lot more confidence. Now this is the producer price index, and the same sort of analysis, the headline without and then the core without the commodity based. And so producer price index cost of production. And you can see it's not too far off the CPI. And so if you look at it on a year-over-year basis, you'll see how both of these have kind of a sharp downward trend. So even though it's 3.1 up and 2.4 up over the previous year, but they're pretty sharp declines, and that's because of these month-over-month numbers. And this doesn't there might be somebody watching saying, well, my cost of production hasn't declined. And really, you can't read too much into this, but it's almost 0.5% less this month than last month in terms of what the surveys are showing the producer price index. That doesn't mean that it's cheaper than a year ago. It just means compared to last month, about 0.5% down. But that's still the fact that it's on both core and headline, both down, is, I think it makes it a little more noteworthy, perhaps. And then looking at goods and services, split out, you can see those down as well on the producer price index. So this, the producer price index can sometimes be a precursor to the consumer price index. Okay, so what does it cost to produce? And then what does it cost to buy later on? I'm oversimplifying that, but think of it in those broad terms. All right, the wage track, the Atlanta division of the Federal Reserve does the wage growth tracker. And this is interesting. I think with the bottom quartile and the top quartile of wage earners, there was a while when the bottom quartile was increasing much faster than the top. It's gone back to a more kind of normal looking relationship, or at least normal going back the last decade. So this going back from previous to the last the last decade. But this is a this is also an indication that employment, you know, these increased rates are kind of coming back to earth, and employment is softening perhaps a bit. So this is also, this one, I don't usually share this graph, but the reason I did here is because it's almost even. So this is job switchers. When people switch jobs, how much more do they make after they make the job switch? And there's historically a pretty good size premium. Somebody leaves because they can make money somewhere else. This would suggest that when people are leaving a job, it's not for money, because the premium at the moment is only 0.1%. So this is the 30-year interest rates. And as you can see, kind of that people for a while, they had lower interest rates, so people weren't refinancing, they were holding. But over time, the rates stay high long enough, or higher than the average long enough, then people move for whatever reason. People have to sell their houses, and then or they hit balloon payments and things are refinancing. So you see that average rate start to pull up as the average rate of everything outstanding is going up at the same time, because the current rates are higher. Last slide here is job openings per unemployed worker. And this, this is definitely, it's another area where it used to be overall, there were 2 openings for every 1 employed worker after the pandemic. And now there's about a 1-to-1 ratio. So all of these signs, if I take just really this whole year so far, but if I look at this report in particular, these sets of data, what it tells me is that the risk of a softer economy, employment issues, potential recession are higher than the risk of inflation. And so if you were to take the question of tariffs out of the mix, I think the Federal Reserve would already be lowering interest rates right now, just based on this data. I think the only thing holding them back now is that they have just this uncertainty of, are there going to be supply chain disruptions and shortages of things that drive prices up? And that's probably, but even that, it seems like some of those questions are starting to get answered now. And so I will look in this next meeting for them to give some clues. Like, it's time for them to start lowering rates.
All right, well, thank you for sharing that with us, Brian. I do want to mention 2 things before we say goodbye today. Well, actually 3. One is we have an owner-to-owner event this Thursday. It's in Ann Arbor at York Food and Drink from 4 to 6 p.m. So if you're going to be in the area, we'd love to have you join us there. The second is that we opened up registration for our annual meeting. This is going to be June 17th. It's in East Lansing at Eagle Eye. We're going to have men's basketball head coach Greg Campy from Oakland University as our keynote speaker. We have some other great topics and a lot of time for networking as well. So if you're interested in joining us there and at the Ann Arbor O2O, everything's on our website at sbam.org/events. And finally, we will not be here next Monday. It's Memorial Day. So we'll be back in 2 weeks. Have a great rest of your week.
Thanks, everybody. See you next time.